Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today, Dallas and Michael here with another listener question. Michael, your topic, your question that you've received.
Thanks, Dallas. I received an email from Glenn just this week, and the email says, "Gents, I'm a regular listener and have given you the 5-star rating."
He's got me already, Glenn.
I'm
Thanks,
doing
Glenn.
the thumbs up right now, Glenn. Thank you. Thanks very much, mate.
Yeah, if anyone else is listening and hasn't done so, please feel free to go in and give us five. As you say, Michael, give us a rating. 5 stars will do.
5 stars will do. Fill those empty stars up. Thanks for the latest podcast, which was number 197, Investing Money Outside of Super. Interesting. So Glenn goes on to say, a big gap for me, however, was you're assuming everyone is working until they are at least 60, which we did. What about those people who want to retire before they are 60? So where investments outside of super are essential, or where there is an age gap between the partners and one retires at 60, but the other's super can't be accessed for a few years. Investments outside of super may be required for supplementation. Can you provide some thoughts on this? Cheers, Glenn. Thanks for your question, Glenn. So it's a good one. So it was remiss of us to actually not cover that. Which we should have done, given that we were talking about investments, and we did touch on, the reasons why you would hold investments outside of superannuation. One of the reasons was if you needed to access it before age 60, but we just didn't dive into that deep enough. So, I actually have a case study that I've just looked at with some existing clients of mine, and we've actually really pulled the numbers apart. So they plan to retire before 60, and we can have a look at those figures. So
the bigger picture, I guess, of this, just to go back to the thing we touched on in the last podcast, but just to reiterate on that, the reason why we drive towards superannuation so much in our conversations is that it is such a tax-effective environment once you are age 60 and retired, and so. Again, just to, I guess at a high level here, if you're looking at retiring before age 60, you may well need to invest money outside of super, but you really only want the money invested outside super that you are going to need access to before you're 60. And this is, I'm sure, what you'll look at, and what you have looked at with these clients is that your focus is probably still primarily on growing your superannuation. If you're retiring at 55 and, if you're retiring at 55, you're probably above average in terms of, again, this is just all the statistics show you're above average in terms of life expectancy. So if you're retiring at 55, one member of a couple is probably going to live to 95. So we're looking at a 40-year retirement here. From 55 to 60 is only 5 years of that retirement. So you do need to fund that 5 years of your retirement, but the bulk of that, the 35 years out of your 40 years of retirement, is still your superannuation, and that's kind of
it's one thing to be aware of, and for this couple that are clients of mine, we've actually we just had a meeting in August, and we really pulled it apart because it's coming up for them. So they plan to retire in January 2026, so the end of 2025 is when they plan to retire. I won't mention names. They'll be listening, so they'll know who they are. But because we're going to look at their situation in detail. But at that age, the male will be 55 and the female will be 50. So quite young in terms of retirement.
People in their 50s love to hear that they're quite young, Michael.
Yeah. The first thing that stands out for me with these guys, and I have some other clients like this, so anyone who can get themselves to be able to retire at 55 and genuinely retire with enough capital or 50, they're usually very good at what they do.
Yeah.
It's unlikely that they're going to work the last day of their life at that stage.
Yeah.
So you don't necessarily have to set up to. The discussion with them was, look, it's highly unlikely at that point in time you're going to work the last day that you're ever going to work.
Yeah.
What they really want to do though
Yep.
is take a step back from the current hustle and bustle of their lifestyle. So basically, to resign from their full-time jobs, to pause, to have a look at what they might be interested in doing. And like I said, it's very, very unlikely that they're going to.
I mean, I remember this from when we had clients who were of all ages and stages. We often had 30-year-olds coming to us and saying, "I want to retire at 50." And then you'd have the meetings with the 50-year-olds who were in a really good position, and they'd be going, "No, 50. I don't want to retire now." It's a really interesting one to see. I guess again at a high level thing is a lot of people who are working towards that retiring at 55. As you get closer, and this I think what you pointed, that goalpost tends to change. It was like a line in the sand of I'm going to work to 55 and then I'm going to stop. I think that's what happens is when you're 30, you think of 55 as relatively old, and then you get to that point and you go, I'm actually still feeling really good. I'm sort of at the top of my game in my career. I've got all this experience. I've got all this knowledge. I've still got the energy to go and do something. I don't necessarily want to completely stop. And, we've talked about this in a heap of other podcasts before that's a part of that planning is to go, the way that I've talked about it before with clients is let's work on worst case scenario, which is you don't do another day of work, but in reality, you probably are going to do something. So we do need to work on that in terms of your tax planning and the rest of it. We kind of need to assume that you're not going to earn another dollar of income, but in reality, you probably will do something throughout that first 10 years of your retirement while you're that bit younger.
Yeah, absolutely. Look, there's a vacuum there, and the vacuum is that you have time in your hands now.
Yeah.
And people that put themselves in those financial positions, they're good at what they do.
Yeah. Yeah,
and it's because they've
spent 30 years, trying to be the best in their field, and so often, like you say, if you remove that, but they're not the sort of people that then just go and sit on the couch and watch TV for the next 10 years.
It's not only they're the best in their field, that their skills are transferable because they're dedicated to get themselves in that position.
Yeah,
they've had to have been ahead of the average person by actually putting money aside and doing that from an early age and all those types of things. Yeah. So they're hard workers and reliable and all those things which make them highly employable. Yes. What tends to happen is they get asked to do a favour. Yeah. Can you come over here and help me?
Yeah, get this thing set up or
get
this new
thing
project
set up
that
and
we've
this
got
project
going.
set up at this company or whatever it is. So I digress.
Yeah.
So let's look at the nuts and bolts of it though. So as of May 2021, when we value all of our clients' assets, they had combined superannuation of $830,000.
Yep.
They also had a net investment position of $600,000. So basically, it's $600,000 of money in investments.
Yep.
And look, we won't go into the style of investments and all those types of things today because there's too much information. But liquid, high growth investments they have diversified. So the total net worth, besides the value of the house, which we don't count, the total investment and super net worth as of May 2021 was $1,430,000. Superannuation again of $830,000. Investments of $600,000. Part of the strategy, and again I'm digressing a little bit, we're actually taking the dividends from the investment every year and running it into their superannuation.
Yep.
In addition to that, they both salary sacrifice the maximum concessional contributions every year. So they've now got a combined $55,000 of their employer's money and their money going into superannuation every year. In addition to that, they have about $24,000 currently of dividends that go into their super funds as well. So we're just running money in as a non-concessional contribution. So basically, by December 25, their projected conservative position at that stage will be their superannuation will have grown from $830,000 to $1,397,000, so very close to 1.4.
Yep.
Their investment, very conservatively, would have grown from $600,000 to $770,000. Now, doesn't really seem like a comparable scenario. Again, just if you can just remember, they're running the dividends from the investment into their super fund.
Yep.
And with their super,
They're
pulling the
extra
lever a little bit harder.
Yep.
Yeah.
Yep.
So basically, what we wanted to have a look at is at December 2025, the position that they're in, roughly 1.4 million combined in superannuation, roughly $770,000 in investments. Of course, these are projected figures as a future value. So, I've got $2,167,000 of total assets, very close to $2,170,000 of assets. So the aim, and this fits in well, I think, with Glenn's topic, is that how to get to age 60 drawing a tax-effective income before getting access to their superannuation. Remembering at that stage, the male will be 55 and the female will be 50. Yeah. So there's an age gap there. He's got 5 years before he can access his superannuation. She's got 10 years before she can access it.
So I guess the way that I think of this is the financial planning aspect is basically cash flow matching, where you go from in that 5 years, from 55 to 60 before the male can get access to their super. We've got 5 years worth of income needs that have to be funded. So we know we can't get it from the superannuation. So that's really the I guess the first hurdle is it's no good, and this is exactly what Glenn sort of alluding to and what we've touched on before, is that it's no point having this $2.2 million in superannuation and going, well, they've got enough in theory to meet their retirement savings when practically they can't get access to that money. So this is the trade-off is, well, that's great that we've got $2.2 million worth of retirement savings. That's enough to draw the income we need, but we actually do need to be able to get access to that money, and we need to be able to do that in a tax-effective way.
Absolutely. So we thought we'd stress test that because that's the plan of attack at this point in time, and what we thought we would do is really, really pull these numbers apart and have a look at how much their investment could generate them at that point in time, and what their superannuation would continue to grow by while they were taking money down from the investment, and have a look at the tax position of that as well. So the first thing I look at to stress test is I say, okay, if you're at that position, what if you never worked another day ever again? Which as I said before, is highly unlikely. But if that was the case, they'd have $2,167,000 of total assets. Superannuation would have about 2/3 of the money in superannuation, about 1/3 of the money outside of superannuation, if we want to break it up that way. Just running the ruler over that and saying, okay, what if you're able to get an average of an 8% rate of return? Of course, it's a what if. However, throughout history, if we look at the right type of assets to invest into, they're volatile. However, that average has been achieved over longer term periods of time, and we've done podcasts on that. So if they were able to get an 8% rate of return and we were able to take no more than 5% of that 8% rate of return, this is very, very back of the envelope stuff, but this is the way that we like to start. I'm going to say they'd be able to draw roughly $100,000 of income from that pot of money. If we say no more than 5%, it'd be a little bit more than that. But let's just round down to $2 million and say 5% on $2 million is $100,000 a year.
And so that's again the high level thing there is.
High level.
If I've got $2 million, if I've got a bit over $2 million, I can draw $100,000 a year. Again, across the board of that. So that's sort of part one is how much income can I actually draw each year, and then as you say, part two is practically if I can draw $100,000 a year across the board, how do I actually get that out of the right bucket of money at the right time?
Yes, that's right. Now it assumes a couple of things. Of course, it assumes that that you can get at least a 5% rate of return. In fact, we would want an 8% rate of return on average.
Yep.
If we're going to take 5% from there.
Yeah.
Because of the fact that I mean, a simple rule of thumb, if you take 5% from 8%, you're reinvesting 3% of that return every year.
Things get more expensive over time, and you can allow for that increased cost.
Your 5% stays at 5%.
I think we actually did it. We did a podcast very neatly named Taking 5 from 8 or something.
Taking 5 from 8, I think it was called, So basically, what we looked at is that from the investment side of things first, they told me, which I knew from seeing what they live off, that they could live off less than $100,000 a year.
Yeah.
So we actually worked on $80,000 in the hand.
Yep.
Now at the moment, they both earn an income. They pay tax on that income each. So it's more than $80,000 gross each that they earn. But then they pay tax. They actually put
money into super.
They put money into superannuation. So salary sacrifice a lot of money into superannuation. They put another $1,500 a fortnight into superannuation. So nearly $39,000 from after tax dollars. And they run the dividends into their super fund, so that's why their super's growing at a fast rate. They put money aside for savings, and they have their normal living expenses and all of those types of things. So what we looked at is once you're effectively retired and your money's getting dressed and going to work for you, I mean, if we can, and again we'll run the rule over this, and we'll look at their tax position in a minute. But if you, for example, can pay no tax, then that saves your costs quite a bit. That minimises your costs.
That's a big point because, and we've touched on this before. I think again, I feel like now that we're up to a couple of hundred podcasts, we spend half our podcast referring to other ones that we've already done. But we talked about this with, like you say, running a rule over what people spend in retirement. The easiest and best way to do that in rough terms is to go, right, what are you earning now? What's your gross income now? What's coming out? What's going to the ATO? What's going out in income tax? What's going to super? What's going to loan repayments? What's going to these expenses that are going to stop? Once you strip all that out, like you say, for these guys, they both earn relatively good incomes. And so you strip out all those things, there's quite a bit there left over. What you really want to check is, okay, what's the net amount that we are actually spending in income needs every year and funding that? And that's kind of what you're looking at.
It's around about $80,000.
Yep.
And so that's the starting position that we've looked at. We've thought, okay, what if we could generate at least $80,000 from their investment? If we could take $80,000 a year from their investments, between 50. Well, the male will be 55. So between 2026 to 2030, basically for those 5 years, when he'll then get access to his superannuation. So the pool of investments have to last at least that long over that period of time. So here's the numbers. So $770,000 of investments and almost $1.4 million in superannuation. So let's look at the investments first. $770,000 worth of investments. First of all, the overall rate of return that we've assumed on that pool of money, because it is working hard for them, is a total rate of return of 8%, made up of dividends of 4% and capital growth of 4% on average as well. So basically from that $770,000 of investments, and these figures are all rounded down, it's to make it nice and round numbers. So they're not exactly to the decimal point. A 4% dividend on $770,000, somewhere around about $30,000 a year. So that provides them with their first $30,000 of income. They no longer take the dividend and put it into superannuation. They take the dividend, have it paid into their bank account, and they spend it. We also then looked at a redemption from the investment.
So they sell down a little bit of the investment every year.
Sell down some of their investment of $40,000, Now, $40,000 on a base of $770,000 is 5.2%.
Yep.
So they're actually
selling down
digging into their.
Yep.
If we said that the total overall rate of return is going to be 8% on average,
Yep.
and it could be less than that. It could be a lot less than that.
Yep.
Could be more than that. But if it is 8% on average,
Yep.
They've taken 4% already in the dividend, and then they've sold $40,000 worth of their investments,
Yep.
which equates to 5.2%. I add both of those together, and that gives me 9.2% that they've taken from their investment for that particular year, and the investments made them an assumed rate of return of only 8%. So they've gone backwards by $10,000
within
roughly.
the investment. And so this is the two buckets of money approach where we think of it as it's one big pool of retirement savings. However, the superannuation sitting off to the side, it can't be touched. It's not being touched. We want it to continue to grow.
That's right.
We're chewing into the investment a bit in these 5 years, but that's completely okay because we know that we've got the superannuation sitting off the side. The investment you're chewing into, as long as you've got enough money, in the investment to get through to age 60, and as long as you've got enough money across the board to fund the entire retirement, that's sort of the main things that we need to be aware of here.
It is, yeah. So their investments going back, if that was all the money they had to retire, this wouldn't be a workable strategy.
No,
because they've gone backwards in the first year. So $770,000 investments. Dividends of $30,000 they've taken. They've redeemed $40,000 worth of those investments as well. So they've sold $40,000. It's given them $70,000 of income in the interim. And they've actually taken a little bit more than the investments returned. So their investments fallen from $770,000 by $10,000 down to $760,000. So it's not quite tread water over that period of time.
Yep.
Following that thought through, so they've got $70,000 of money in their bank account now.
Yep.
And we need to look at the tax ramifications of that. So if we look at the dividends, so they have come with some franking credits.
Yep.
And
which, again, we've done a podcast about franking credits in great detail. If you want more detail, go back and search that one. But this is where the franking credits are really
really powerful here. So we're now jumping across and looking at that tax situation. So at the start,
because the point. Sorry, just to elaborate there, the point that you're making here is that they've got $70,000 that they've actually taken out of the investment. But it's not. It's like a wage that they've sort of been paid. We need to allow for the tax effect of that. It's not like that's money hits the bank account and that's all there is to it. You then need to flow through the tax effect of that.
We do. So let's have a look at that. So basically they've received $30,000 of dividend, and we'll work out the capital gain. So the sale of $40,000 worth of their investments is capital gains tax assessable. We'll work that out in a minute. First of all, though, what they've received is $30,000 worth of dividend, which is taxable to them. Now, remembering that they've retired, this is the first full year where they don't have any other income. So they get the use of the tax-free threshold, which is $18,200 each. Yep. They can earn up to pay no tax on that. There's low income tax offsets that kick in after that. There's different brackets. So first of all, taxable income dividend of $30,000, that's split two ways. This investment's owned in joint names, which is really, really powerful if you're a member of a couple. And unfortunately, single people get a little bit discriminated against because their costs aren't half of what a couple's are. In terms of couple, they can split income across two marginal rates of tax. So $30,000 of dividends split $15,000 each of taxable income. They also have franking credits that add up to about $13,000. Now, the franking credit is actually added to your taxable income before you get it back as a rebate later on. It's a very, very complicated calculation, but let's just, to be fair, add that on as well. So $13,000 split two ways. $6,500. So we're at $21,500 of taxable income each, or assessable income each. which basically they pay no tax on.
Yep.
We now have to look at the capital gains.
Yep.
So from that redemption of $40,000, and these are the real figures, and they've been invested. That investment has been running since 2011. So they were one of our earliest clients. These people. So I've looked at the worst case scenario. We've looked at the bucket of shares that they've owned for the longest.
Yep. And that have grown by the most.
They have the
gain.
highest capital gain. So they can actually redeem $40,000 worth of shares at the projected share position or the share growth position of December 2025. And from that $40,000 of money that's hit their bank account from selling $40,000 worth of shares, basically it's come down to $7,000 of taxable capital gain.
Yeah.
And that's the worst case scenario for them.
So this is, and I think we, again, we won't go in the weeds too much here, but basically when you sell an asset, you get $40,000. The capital gain is based on the $40,000 sale proceeds minus the amount that you purchased those shares for. You get a 50% discount on that for owning the asset for more than 12 months. So the actual gain gets discounted at 50%. So the 50% of that gain gets added to your taxable income. And I think this is, again, a bit of a confusing one for people because we talk about capital gains tax as though it's a separate tax. But what just happens is that calculation gets done and then the discounted gain gets added to your taxable income. So it's a simple calculation to get rid of. This is the taxable income they've got from their dividends and their franking credits, plus the taxable income from the capital gain, and that's their total taxable income for the year.
Yep, 100%. So basically, if we add on the $7,000 of capital gain, that gets split each half to each of them. So it's an extra $3,500 each.
Yep.
It takes their total assessable income up to $25,000 each. So basically, running through those numbers again, they got $30,000 of dividend.
Yep.
That's split two ways, half each. $15,000 of income each. They've then have $6,500 of franking credits each. $13,000 combined. Now that's added on.
Yep.
They then have that $7,000 capital gain from the $40,000 redemption, which is then split two ways as well. So $3,500 each. Takes each of their taxable incomes to $25,000.
Yep.
Now, the tax that you pay on $25,000, it's under $1,000. Like I can't remember the exact figure.
This is the point you touched on. You get all these low income tax offsets.
Yeah.
So
the first $18,200 is tax free.
Yeah.
And then you get low income tax offsets. So pushing up out of that. So basically, the tax that they owe was under $1,000. The tax that they owed was under $1,000 each.
Yep.
Here's where the power of that franking credit comes in. So they then get the franking credit, which is $6,500 each, as a full tax rebate. So just to be clear there, if you owe $1,000 in tax, and you get a franking credit added to your, you get a franking credit rebate then applied of $6,500.
Yep.
You get a $5,500 tax refund from the ATO. It's such a powerful thing.
And so that's again, the ATO basically is calculating that, saying we have taxed you at $6,500. The ATO has received $6,500 on your behalf. They do this calculation, say you should have only paid $1,000. You did pay $6,500, therefore you get a refund of $5,500 each.
These clients, their actual refund adds up to $10,800 combined. So they get $5,400 of tax return each.
Yep.
So franking credits are significantly powerful.
Yep.
A very, very powerful thing. So we've worked out their tax. The tax position is no tax payable.
Yeah.
They owed the initial calculation was they owed a little bit of tax on their $25,000, under $1,000.
Yep.
The franking credits get added back then as a full rebate.
Yep.
And it basically wipes out their tax and then pays them the surplus amount. So they get $10,800 of combined tax return, $5,400 each. So if we run through the numbers again, it takes their income to over $80,000 in the hand, $30,000 from a dividend.
Yep. $40,000 redemption.
$40,000 of redemption.
And just over
and after
refunds.
applying and after running the ruler over the tax scenario, they get a bit over 10,000 in tax returns. So it takes their income up to a bit over 80,000,
and this is
80,800.
It's a really good example of we talked about the after tax income, the amount that you get to keep and that you get to spend is the real metric here because. So, for example, if there's a couple where only one member is working and that person is earning $110,000 of gross income, so someone who's earning $110,000 worth of gross income from their wages pays about $30,000 in income tax.
Yeah.
So these guys basically get to keep $80,000 of net income from this investment without really chewing into it too much. Not only do they not pay the $30,000 in tax, they actually get a $10,000 refund. They're in the same position as a couple would be with one member only working who's earning $110,000 salary.
Yeah, absolutely.
And so that's kind of where you're saying it's very important to flow through the tax implications of this is to make sure you understand the impact of the dividends that you receive or that taxable income from any dividends or distributions, and the tax impact of any capital gains. If you are selling down assets to fund your lifestyle, you need to take into account the tax effect of that. But
yeah, you do, and
it's a really handy one.
It's a really handy one. The other thing that they have up their sleeve is that if either of them gets a job, that pushes their taxable income up, but they're within their rights to put in $27,500 each into superannuation. So, for example, like I said before, people get talked into doing something. Yeah. So it goes a little bit like this. Can you come and help me set this project up? It's going to last for a couple of days. That couple of days turns into a couple of weeks, which turns into a couple of months, which turns into the year. Yeah. So what happens is that, let's say one of them earns $100,000 for that particular year. Then they're within their rights to put in $27,500 into superannuation, including what their employer would put in, and claim that as a tax deduction as well. So they'd pay a little bit more tax then. They'd earn a lot more income, of course. So you've still got that up your sleeve.
Yes.
And if that doesn't come about, actually, no, they're well over the limit. Yeah. I was just having another thought there.
Carry forward.
Now, to look at their overall position.
Yep.
So we said before that they actually didn't quite tread water with their investments. Their investments
went backwards
for that particular year. So their investments fell from $770,000 to $760,000. Yeah. However, the nearly $1.4 million that they had in superannuation without any contributions going in, if that was able to achieve that 8% rate of return, that's moved ahead by over $110,000. Yep. So their net position, if you have a look at it, superannuation's grown by over $110,000. Investments have fallen by $10,000. Let's just call that a nice, neat $100,000. So their net worth's increased by $100,000, and they've been able to live off an $80,000 after tax income in this scenario.
And so I think I guess the bigger picture here is. You're probably, and this is I'm sure what you've done with the planning of this, you've probably erred on the side of having slightly more in the investments than what they really necessarily need, because you don't. If you have those 5 years of very lean returns where you don't get that 8% for that first 5 years of their retirement, you want to make sure that they've got more than enough in the investment so that they don't get to 58, 59 and have chewed through the investment too much and run out before they can get access to super. But the balancing act there is that. As we've seen from the tax effect of the dividends flowing through and the capital gains on that, if you could time it perfectly right so that you basically spend all of the money in your investment, on the day you turn 60, that would be ideal, because then you've got as much money as possible working for you in that most tax effective vehicle, which is your superannuation. You've got the minimal amount of taxable income flowing through from your investment. So it's really a balancing act there of going, we want enough in the investment to fund those early years of retirement till we get to age 60. We want to make sure we've got a healthy buffer there, that we're not worrying about or stressing about what the sequence of returns is in those early years. But we don't want too much in the investment. So in this case, if they had $2.2 million of retirement savings and they had, in the extreme case, if they had, $2.2 million all invested in their own name, it'd be a complete waste because they basically spend the dividends, spend a portion of the dividends effectively. They would pay they wouldn't get a tax refund. In fact, they'd pay probably a little bit of tax on that.
Yep.
Rather than getting to use the tax savings available from through super, they would actually be paying more in tax. So that's that balancing act that you're trying to get right there, is to go, right, if you've got to 55 and you've got 2.2 mil, how much of it do we want in the investment phase and how much of it do we want in superannuation to get that right? Make sure we can get through the 5 years, but also have the bulk of it in that right environment where you're not paying as much tax.
Absolutely, and it gives you plenty of time to plan as well, because by the time that each of these members of the couple get to age 60, the current legislation is they've still got another 7 years that they can actually put money into superannuation.
Yes.
So without meeting the work test.
Yeah.
So if they met the work test after that, then they'd have even more than that.
Yeah.
But with it, assuming they never work another day in their life, which is again highly unlikely, you get to 60 and you go, okay, well, I end up with this money, the investment. I've still got $700,000 in the investment.
Yeah, I want to push some.
Okay, I want to push some into super because I've got access to my super now, and I can basically move my super into a 0% tax super income stream. Hang on a sec, I'm going to pay a lot of capital gains tax if I sell the whole $700,000 bundle. In one fell swoop.
But I might.
Okay, I can trickle it in.
Yes.
We can sell $200,000 this year and put that money in.
Yep.
You tap into the bring forward. You tap into the bring forward of the non-concessional contributions. Then.
Yeah.
Let me back up. You've got each person's got $110,000 of a non-concessional contribution they can put in each year.
Yeah.
You can bring forward 2 future years, so you can put in up to $330,000 in one particular year. So, basically, if it panned out, you could actually the male's going to hit 60 first. He hits 60.
Yeah.
Okay, we've got $700,000 in investments. Well, we could actually sell $330,000 of those investments.
Get it into the tax.
Put that money in as a non-concessional contribution into his super fund, and then he's done for that 3 years before he can go
and
again.
He gets that into his 0% super income stream.
0% taxed income stream.
Yep.
If that crystallises a bit more capital gains tax than you liked, it's always a prerogative to actually sell a little bit more and make a concessional contribution and claim that as a tax deduction. So,
and I think so. The overarching point you're making, I guess, there, Michael, is that if you, it's the old saying, better to be looking at it than looking for it. So you'd rather get to 60 and go, oh, we've actually got a bit left in this investment that we don't really need. We then have the choice to, if we want to or we need to make sense from a tax point of view, we can sell that down and push that into superannuation. But you're better off having a bit more in the investment than what you really need, rather than get to 59 and run out of money in the investment and go, well, geez, what do we do for the next year until we can get access to super?
Yeah,
so
that's right.
I think there's sort of the two parts that are. There is still some planning. You err on the side of having a bit more in the investment than probably what you need, just to make sure that you do get through, and that there's some planning work that you can do from sort of 60 onwards to minimise your tax rate, your retirement. I get the point there, though, is that you really only want to be doing a bit of a tidy up job at that point. You don't, as you said, you don't want to get to 60 and go, well, I've got $2.2 million in the investment and nothing in super. I really want all of this money in super now. How do I get it in? I can't get that whole lot in. So it's basically you do the planning like anything. You'd sort of do the rough plan of these are the range of possible outcomes when I get to 60. Err on the side of caution there and having more in the investment than what you need. Then get to 60, reassess, and you can juggle that around if and when you need to at that point in time.
Yep. So that was interesting. Thanks for pointing that out, Glenn. Yeah. Because it was remiss of us to actually go into that level of detail.
Yeah.
And this was an enjoyable one to do actually. So
it's great when you get a listener question and it lines up with something that you've just looked at for a client and you go, I've got exactly the numbers here. I can just go and pull them out of the spreadsheet and away you go. So if anyone else has any other questions or case studies or thoughts or queries or whatever, these listener questions it's good for us to get the feedback as to what what are the actual things that listeners want to know more about, or situations that they are in or facing, and because obviously if you're listening to this and you're in this situation, there's probably someone else out there who's in the same boat. So it's great for us to get that feedback and get those ideas. So if you have any other listener questions or any feedback or anything like that, if you can send us an email at podcast@mo50.com.au.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.